Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain, and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Adam, welcome back to the Investor in the Family podcast.
Always great to be back, Brian.
Hey, well, fun to be with you as well. And today we're going to talk about Enbridge and IBM. You recently on Seeking Alpha wrote an article said, forget IBM, Enbridge, a fast-growing 6.5% yielding blue chip, is a far superior investment. So can you defend that? Can you tell us what's going on there? What's your thesis and what should investors know?
Well, actually, yes. And the update is they just hiked their dividend by 10%. So now it's closer to a 7% yield. And so basically what I've had some people ask me about IBM for a long time. And I've been interested myself because, it's one of the oldest tech companies in the world, founded over a century ago. They're a legend, and they're the biggest IT company in the world. Like 95% of the Fortune 500 operations in on every continent, and 22 straight years of dividend growth. And so it's one of these. It's undoubtedly a high tech blue chip that management has been saying the right things. I mean, Virginia Rometty, the CEO, came on board in 2012 and had this grand vision. It's like, hey, legacy hardware, we're going to be shifting away from that. We're going to be selling assets. The cloud is the future. Strategic imperatives. It's like, future tech, baby. We're talking AI. We're talking Watson. We're talking about all this Star Trek tech of the future that everyone's so excited about. She said all the right buzzwords, and she's like, okay, we're going to grow this, quickly, and it's going to, return us to solid long-term growth, and it's going to be how we turn this thing around. And so essentially for 8 years, they've been trying to do that, but revenues up until very recently have been declining, every year. In 2015, they said, hey, we're going to have $20 in adjusted EPS. They missed that by a mile. And recently, that positive revenue growth that they've had has kind of turned around, and now their strategic imperatives, that future tech, is that it's started to run into trouble. Essentially, like the problem is that their cloud business has been losing market share. The growth has been decelerating, and meanwhile, all that money they spent on Watson, they've been hyping that for years. I mean, Watson was the computer program that beat Ken Jennings and on Jeopardy, and they're supposed to be like going to change the world, and it's just like it's not working out. It's not hitting the top and bottom lines at all. And so people have asked me about it, especially since a few years ago, Buffett, that was the first tech company he ever bought. He was famous that like technology is something he doesn't want to touch, but hey, he believes in the IBM turnaround. So a lot of people jumped on board with Buffett, and Buffett recently sold IBM completely, saying, well, he didn't give his reasons, but we probably assume he just doesn't believe in the turnaround anymore.
Well, yeah, I think it's probably a safe conclusion.
And so now with IBM yielding over 5%, people say, yeah, but it's trading about 9 times earnings, over 5% yield. Management says that, hey, look, long term, our earnings and cash flow is going to grow 7 to 9%. So that means about 8% dividend growth over the long term. And say, hey, if you got 5.5% yield and 8% long-term dividend growth, hey, that's 13.5%, total returns right there, even if the valuation never improves. It's like, how can you go wrong with that? And so the point that I was making in this article is that it's something, unless you're Warren Buffett sitting on $80 billion in investable cash and generating $8 billion a quarter in free cash flow, you've got to consider opportunity costs, because you've got limited capital, and especially in a correction like this, where you've got, world-class blue chips, grade A industry leaders, fast-growing companies trading at bargain basement prices. You've got to be very, very selective. I mean, hey, this correction alone, I bought $100,000 in 13 companies. That was in the first 2 legs of the downturn. I'm tapped out right now. And so it hurts my soul that I got to watch the market keep dropping and all these bargains keep getting better.
And your cash is spent.
Yeah, I can't do anything. And so that's the thing that, is like, at times like these, it's like, why buy something like IBM where, so in the article I specifically pointed out, it's like, look, let's think about this logically. Why would someone want to buy IBM today? It's like three main reasons. One, the yield. It's, above 5%. Hey, that's awesome. Markets only yielding 2%. The second is the valuation. And the third is, I suppose, if you believe the turnaround growth potential, like what they just did with Red Hat, where they're like, oh, Red Hat, this acquisition, this Linux-based cloud platform, it's a total game changer. That's what their CEO says. Like, look, this open source thing, 80% of companies have not yet moved to the cloud. So this is just like the early stages, and what we're buying is essentially where the entire industry is going. So she's claiming that, hey, we're jumping ahead of everybody. Now we have this competitive advantage. And even though we've been losing for 6 years to Amazon, Microsoft, Alphabet, Alibaba, all the big players in the industry, well, we just changed the game by paying a 70% premium and 30 times cash flow for this company and taking on a whole bunch of debt.
Yeah, sounds bad.
And it's like, look, we've heard this kind of stuff before. And meanwhile, so again, so you're looking at those things. I always point out to people, it's like, look, if you want a generous, safe yield, 5.5%, yeah, that's great. Enbridge is offering even safer yield, that's 7%. Now, you might ask, well, what do you mean by safer? Is IBM unsafe? Well, if you look at just the core stats, stuff like payout ratio, let me see like what that is there. But yeah, I mean their payout ratio, it's under 50%, and balance sheet, so under 50%, that's safe. And the balance sheet, even with the Red Hat, I mean it's going to go up to 4.3, but it's
Okay, wait. Are you talking about IBM or Enbridge now?
Oh no. So I'm saying IBM from the perspective of safety. It's like if you look at the payout ratio on the balance sheet, well, the balance sheet, that's going to get ugly, but they're saying, hey, look, we'll pay this thing down by 2022. We'll be back to historical norms. Okay, let's give management benefit of the doubt and say, yeah.
So you said the payout ratio for IBM is under 50%.
Yeah, it's 44%.
Okay, and remind us quickly what the payout ratio is, just for anyone who's wondering.
Oh yeah, so that's the dividend over the cash flow.
Awesome.
So for IBM, that'd be the free cash flow. For Enbridge, the distributable cash flow.
Gotcha.
And so from that perspective, 44%, and once they finish the deleveraging, it should be safe. But the thing that I always point out to people is, look, IBM has this history of successfully pivoting, but when they do, sometimes, like in 1993. They were completely flailing. I mean, they'd rested on their laurels in the 1980s completely. Microsoft had eaten their lunch. All their hardware was essentially the Japanese were crushing them on that. And so in 1993, they decided they're going to have to pivot. They bring in a new CEO, completely shakes everything up, cuts the dividend twice by about 80% over a 3-quarter period. And so I'm not necessarily saying that's going to happen again, but when people say, well, IBM would be great if we could just replace the management. The board should fire Rometty because she's a failure. It's like, okay, but if you do, just remember the last time that happened, it did not work out so well. And in contrast, you got Enbridge run by Al Monaco, who's been with the company for over 30 years. He's a legend. He's great at execution. And you look at that Enbridge right now, the payout ratio is 62%. Their balance sheet is now 4.7 and falling steadily over time.
Payout ratio is 60 what percent?
62%.
Okay.
But yeah, for the industry, basically anything under 85 is safe. It's based on like the business model, and 96% of cash flow is under long-term contracts with essentially investment-grade counterparties and utilities, less than 1% exposure to commodity prices. So I mean,
just to be clear, so actually IBM payout ratio is better than Enbridge if low is good.
Well, it is, but again, it's a different industry, so it's
Gotcha.
basically slightly different standards. But the point I was making is like, Enbridge, with their payout ratio, with their balance sheet, with their track record. In fact, now with Enbridge's latest hike, they've hiked their dividend 24 straight years in a row at double digits. Next year, when they hike, like literally 12 months from now, they become the industry's first dividend aristocrat. So IBM is on its way to becoming an aristocrat. Enbridge is going to beat it by a year. It's got a safer dividend, a higher dividend, a faster growing dividend. If you're looking for a safe and generous and fast growing yield, Enbridge has got IBM beaten on all counts. And then in terms, if you look at the management quality, IBM's management is all hype. It's all sizzle but no steak. I mean, they can't deliver. They keep promising and making guidance and then missing on it. Enbridge, they provide guidance and they almost always hit it, and usually in the upper half of their guidance. And so if you just look at it from that perspective, one of the most important thing of any investment is the quality of the management team. These are the people making all the decisions. There's always going to be risks. There's always going to be challenges in any industry. Something's going to go wrong. You have to adapt. You have to, invest our capital well and wisely over time. Enbridge just has a much superior track record over time than IBM. So if you look at, management, the dividend profile, and so finally people say, yeah, but IBM, it's so cheap, man, deep value. I mean, 9 times earnings. It's literally priced for no growth. If they can deliver that 7 to 9% growth, it's going to just blow up. And it's just like, yes, but then if you look at Enbridge, it's like with their latest dividend hike right now, Enbridge is trading at under 10 times cash flow. And they're about 45% undervalued. IBM is maybe about 35% undervalued. And again,
okay, you said Enbridge is how much undervalued?
45%. Now that's based on dividend yield theory, which has been proven highly effective since 1966. You basically compare the yield to its historical yield, which works really well for dividend blue chips. And so, yeah, IBM
and how undervalued is IBM? So Enbridge is 45% undervalued, and what was IBM again?
34% for IBM, 45% for Enbridge.
Gotcha.
And so, yeah, but the thing to remember about that is that it only works if the thesis doesn't break. If a company continues to execute and grow at roughly the same rate it has in the past, then the yield will come back to its historical norm. For IBM, that'd be 3.5%. And for Enbridge, it would be 3.6. But with IBM, the problem is their growth rate has completely fallen off a cliff, and they've been spinning their wheels for 6 years. And so anybody who looks at IBM as this deep value play has to have really good confidence in management that for 6 years has completely sucked, and say, this time is different. Why? We bought Red Hat. That's
right.
A game changer, baby.
We spent a lot of money.
It's like absolutely, we blew up our balance sheet and we've completely limited our financial flexibility. And God help us if there's a recession and credit markets dry up. But it's a game changer. It's a game changer. And it's like, it's just like, that's the thing, is like Moody's actually put IBM on a downgrade warning, because up until now, IBM has been doing bolt-on acquisitions, but they've been buying, like Apple. They'll buy a small company that specializes in a specific niche in AI and be like, hey, we're going to integrate that into Watson. It's going to be great. We're going to improve our stuff. Now they're just going out. They're making the biggest software acquisition in U.S. history, funding it mostly with debt. And saying that, no, this time is different. This is going to make us hit our targets. And it's just like, hey, it's at this point, it's show not tell.
Yeah.
And meanwhile, Enbridge,
right.
and some people will criticize me for, because I've been pounding the table on Enbridge for years now.
Yeah. We've talked about it before. Yeah. And
it's just like people saying, hey, look, 4 years, this thing has gone nowhere. It's 4-year bear market. And it's just like, look, as Buffett likes to say, you're not right because people agree with you. And by people, he means the stock market. You're right because your facts are right. And in this case, for any company, that means look at the fundamentals. So for dividend investors, that means you look at the cash flow, you look at the dividends, you look at the balance sheet. And with Enbridge, look, the balance sheet's been getting stronger. The cash flow's been growing at double digits. The dividend's been growing at double digits. Management, that's all they can, all they can control is, look, we've got $20 billion in projects we want to bring online. They're hitting those targets. We're going to grow cash flow at about 10% and dividends at 10%. They hit those targets. They're doing what they promised, and they're giving us a safe 7% yield that's growing at 10% for next year. And then the latest guidance that they just revealed is beyond 2020, they expect they're going to be investing about $3.2 billion in growth projects over the long term. That should 5 to 7% cash flow growth. So basically that means that the dividend is going to grow in line with that. So you've got a 7% safe dividend. It's going to grow 10% next year, and then basically 6% a year over the long term after that. And so if you look at that from that perspective, it's like, look, IBM theoretically might be able to match or even exceed those targets. But again, I don't trust management. You got to show me that you can actually put up some positive growth of any kind.
Right. And less magic tricks with big purchases on debt. So tell me, so basically, so the big idea here is that, a lot of people are coming to you and saying, hey, IBM is down, it's great valuation, all these things, and, there's no growth priced into it whatsoever. So great opportunity. And you're saying, yeah, there's potential there, but why spend your money there when there's such other great opportunities? And one great example of one of those other opportunities is Enbridge. And that doesn't mean that IBM can't work out. Doesn't mean it can't be a good value, but there are just much better opportunities in your opinion than IBM. And Enbridge is just one just kind of flashing the buy signal in your mind.
Yeah, it comes down to risk. Now, there's lots of different ideas of risk. Some people look at risk as volatility. What's the probability the share price will drop? Other people will say, hey, it's a permanent loss of capital. For me, the big thing for risk is what's the risk that dividend's going to be cut. Now, IBM, its big risk is what's the probability that the long-term thesis will play out. And that essentially keeps dropping quarter after quarter because they just cannot seem to get it's not that the wheels have necessarily fallen off the bus. It's just that my concern for IBM is that 10 years from now, that their adjusted EPS, their free cash flow per share is going to be the same. And essentially the dividend is going to end up eventually, once the Red Hat debt is paid down, they'll get back to buybacks. They'll be able to probably buy back 2% of shares a year. And so maybe they'll be like AT&T and they'll just be growing the dividend at an inflation adjusted to, just 2% the rate of inflation. But the problem is at that point, you look at something like AT&T where people say, well, when it was at 5%, they're like, oh my God, it's such a great blue chip, a dividend aristocrat, 5% yield. That yield can't go any higher. Then it hit 5.5, can't go any higher, 6.5. And it's just like, that's the problem is like, if you've got poor management with a poor track record of execution that cannot deliver on growth. And if IBM ends up just essentially going sideways, then it's like, how much is a company like that worth? Well, Benjamin Graham actually figured that out for us. He basically says, look, a company with stable earnings that pays it all out as a dividend, with no earnings growth potential for the next 10 years is worth 7.9 times earnings. And so, when people say, well, IBM 9 times earnings, it's like, yes, it could fall even more and the yield could go even higher. And so that's the thing is like, my big thing is it's not a yield trap, meaning the dividend is necessarily likely to be cut. Although, of course, it could if management shakes up and they decide to throw out the playbook and try something completely new. But the biggest issue that it's a value trap in that the risk of their long-term turnaround plan succeeding at this point keeps rising quarter after quarter. And then with Enbridge, it's just like, look, it's like, yeah, the share price can be volatile, but at this point, there's not much more downside. And you look at their execution, it's absolutely phenomenal. It's basically a utility. It's like it's a 7% yielding utility with 10% dividend growth next year and 6% long term after that. And so it's just like, you look at that and 45% discount to fair value. It is a coiled spring that's got about 18% total return potential over the long term, and that's based on a 10-year outlook. And so it's just like
You say with 18 point what percent return value?
yeah, about 18%. If you look at yield plus long-term growth potential plus them returning to fair value over a 10-year period, that comes out to roughly about 4% a year as well. That the share price will outgrow cash flow and dividends over the long term. So you add that up. That's basically total return, over time since 1956 under the Gordon dividend growth model. It's been proven it's yield plus long-term cash flow growth plus the valuation change.
So the 18% annual total return value, which is basically yield plus appreciation, essentially.
Yeah. So that's factored out over the next 10 years, basically. It's just like 18% annualized returns over the next decade.
Yeah.
Which is one of the best. I mean, look, the S&P 500, Vanguard just updated their outlook, which I happen to agree with. I expect 6 to 7% from the market over the next decade. Vanguard says 5 to 8%. So it's like, the market's going 5 to 8, which is below its historical 9.2. And then meanwhile, you've got Enbridge that's likely to deliver 18. And then, it's like IBM, if everything goes right, might get 17%.
Yeah.
So,
well, and that's the thing is like, again, if someone's looking to make a comparison, the management factor just seems to be a huge thing here. And obviously you've mentioned that, but you look at the two companies and IBM could be a great value if you had reason to have confidence in management's ability to bring about a turnaround. And, that can always happen, but based upon track record and current actions, it's hard to have confidence in management doing that. They might, but obviously as investors, we don't know the future and we're not sitting in the room with management. So we have to be able to evaluate from the outside, how well can these people lead the company? And with Enbridge, you mentioned the CEO has been at the company for 30 years. They have a great track record for execution, and it appears to be undervalued and great growth potential in terms of the yield and stock appreciation, cash flow, everything else. On the other hand, IBM has a lot of weight on its balance sheet, and it's losing market share in key areas, and they're putting a lot of their hope in massive debt-fueled acquisitions, which, historically speaking, is always bad. I mean, something can always work out, so you can't say always, but historically, those are very bad indicators.
Yeah,
So,
Harvard Business Review actually did a study. They found 70 to 90% of acquisitions fail.
Well,
and
especially if they're heavily debt fueled, because then it makes it so much more risky.
Oh yeah, absolutely. And the thing about it is, it's not just that it's the ones that succeed is something like, it's like if you look at another company I like, Broadcom, where it's like their CEO, he spent his entire career putting together really smart deals where he'll buy a company that he'll be largely not entirely debt fueled, lots of equity involved, but it's highly accretive. He hits his synergy targets. He sells off the parts of the business that are low margin, slow growing. He keeps the best parts of it. He improves them. And it's like, that's the thing, is like those 10 to 30% of acquisitions that work out over time is like the ones where the management team has been there a long time and has a strong track record of execution that essentially it's kind of like, you look like at Buffett, for example, right? He is a master of acquisition. He's built the greatest conglomerate in history by buying smart businesses at good prices, and he's made it work. And the problem is that's the thing, is like if you look at all these big acquisitions like AT&T, their track record on acquisitions is quite terrible.
Right.
IBM, the same thing. Now they're their track record on turnaround hasn't succeeded. They've been making these small bolt-ons. Now they're completely shifting course and saying, okay, now we're going to do the biggest software acquisition in history. We're going to fund it with that, and it's going to work. And it's just like, and how is it going to start suddenly working? Trust us. It's just like,
and this is one of the reasons why I love listening to The Most Important Thing About Howard Marks. I just have the audiobook and just play it in my car all the time because it helps so much with perspective. And when you have that mindset, kind of your mind in that place, in the kind of long-term investing philosophies that he describes there, you can realize just the dynamics of the IBM deal. Again, things can always work out, but that's not our job as investors, is to think about the long shot of something working out necessarily. 'Cause if you're looking at dividends and value and opportunities like that, a big deal like that, based upon what I know of it, definitely communicates conversely, like in terms of like not a positive and stuff. But
oh yeah, I'm glad you brought that up. I just finished listening to that book. I loved it.
Oh man, I just play it over and over in my car all the time.
It's absolutely phenomenal.
Yeah.
And that's the thing is like, look, the whole point of dividend of being a value dividend growth investor is that what we're trying to do is called alpha stacking. Look, dividend stocks have historically outperformed non-dividend stocks. Dividend growth stocks have been the best performing asset class in history completely. High yield stocks tend to outperform lower yielding stocks. Value stocks outperform as well. And so we're trying to basically combine all these approaches. And the idea is that by doing all this, we minimize our risk because, the lower the price you pay, the higher margin of safety. Something like Enbridge, for example, that's the idea of, what we say. Like when people say, hey, IBM, nine times earnings is priced for zero growth. Enbridge at 10 times cash flow is priced for 1% growth. And so the idea is that, hey, when you're paying for so small that the growth rate the market is pricing in is so small that, the hurdle they have to clear to experience multiple expansion, essentially, even, if the wheels fell off the bus, it would still be a good deal.
Right.
And then on top of that, while we wait for that, that long-term growth potential, we're getting that rich yield that's safe. And then over time, if you got good management with a good track record of execution, something like Enbridge, which is, next year becomes a dividend aristocrat, then it's just like, look, you've got that strong growth that's going to be, that creates the natural catalyst for share price appreciation over time.
Right.
That valuation expansion, that also just adds, that's cherry on top. And then meanwhile, you get paid that 7% to wait. And, next year with all this stuff, I'll be doing some articles next week explaining how, most likely the markets next year is going to go up between 0 and 10%, depending on how the trade thing goes out. But it's very possible that the market might trade flat next year.
Sure.
Well, imagine if you've got Enbridge there with that safe 7% yield, and you're going to get that 7% dividend. In 2017, when the market's up 22%, 7% doesn't seem like much. But when the market's being crazy and volatile and everyone is, scared out of their minds, knowing that you can sit back, you've got limited downside for the share price, and most likely if the market trades flat, Enbridge is probably going to beat it because value is going to outperform. But let's say even it trades flat, you're going to get 7%. 7% versus the market's nothing.
It's pretty great.
And it's, that's the thing is like, look, I'm not saying growth is wrong. I've got about 4% of my portfolio in Amazon. Which doesn't pay a dividend. It's the only non-dividend stock I own. But it's like, look, if you own a bunch of tech stocks and you're flat in 2019, it's going to be a rough year. At least I'm getting paid. My yield on cost is 6%, and that's growing at 15% a year. So that's all I'm saying.
Adam, this has been fantastic as always. Thanks so much for walking us through. And the thing I've enjoyed about this too is it's specific decision based. Specifically for people who are looking at IBM. This podcast, this article is for you, and hopefully it'll be helpful to everyone listening and reading. And Adam, thanks so much for doing all the hard work you've done to help get everyone else ahead and contributing on Seeking Alpha and everyone else. And as always, great to have you on the show today.
Oh, can't wait to be back, Brian.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.